Welcome back, everyone. In today's video, we're diving deep into the state of the U.S. housing market as of late May 2025. Let's start with mortgage rates, key to how much people pay every month. As of May 25th, the average 30-year fixed-rate mortgage is at 6.86%, the highest in 3 months according to Freddie Mac data. Other trackers like Mortgage News Daily have rates topping 7.1% in some areas. What's driving these high rates? A key factor is inflation, which remains above the Federal Reserve's 2% target. But there's more. Moody's downgraded the U.S. credit rating in late April from AAA to AA1. This signals to investors that lending to the U.S. government is riskier, so they demand higher interest rates on Treasury bonds. Because mortgage rates are tied to these yields, they're climbing too. For homeowners and buyers, that means more expensive monthly payments, shrinking budgets for home shopping, and even sidelining some buyers completely. Now, let's talk inventory. More homes are hitting the market. Nationally, active listings jumped by 7.6% year over year. In some hotspots like Texas and Florida, builders are slashing prices and adding perks to attract buyers. But even with more homes for sale, demand is cooling. April 2025 data shows existing home sales fell to their slowest pace since 2009 as buyers face affordability crunches with high rates. Sellers are motivated by job changes, financial strains, or fears of a downturn. Builders are offering discounts, but buyers are still hesitant due to the high borrowing costs. Home prices tell an interesting story. The national median resale price is up 2.7% to $403,700, but it's a tale of two markets. In states like Rhode Island, Connecticut, and New Jersey, prices have jumped over 7%, driven by tight supply and strong local economies. Meanwhile, markets like Utah and Idaho have seen prices drop by 2% or more, showing that affordability is becoming a real barrier. Buyers in pricier markets face even steeper hurdles, while some areas are seeing a modest direction. Beyond interest rates, climate change is an emerging threat. A report from First Street Foundation estimates that climate-driven foreclosures could total $1.2 billion in losses this year, hitting about 19,000 homes, especially in flood-prone areas. Adding fuel to the fire? Insurance premiums are rising fast, with some insurers pulling out of states like California and Florida. Homeowners are left to pay more or go without coverage entirely. Even if buyers can afford the mortgage, rising insurance costs or gaps in coverage are making them think twice. Another headwind, the restart of federal student loan payments last fall. Over 2.2 million borrowers have seen credit scores drop by more than 100 points, more than a million by 150-plus points. Monthly student loan payments strain budgets and raise delinquencies. Lower credit scores mean fewer borrowers can qualify for the best mortgage rates. Some can't qualify at all, making homeownership even harder. Political decisions are adding more uncertainty. 1. President Trump wants to privatize Fannie Mae and Freddie Mac. They support 70% of the mortgage market. Without government backing, borrowing could get even pricier. 2. New Liberation Day, tariffs are adding 25% plus costs to key building materials like steel and lumber. Builders are passing those costs to buyers. 3. Tax cuts proposed by the administration could add $2.7 trillion to the federal deficit over the next decade. More debt equals higher Treasury yields equals higher mortgage rates. 4. Trade tensions with Canada and Mexico are making imported building materials more expensive too. 5. Finally, nationwide protests like the 50501 movement and May Day rallies are fueling political uncertainty, which can shake consumer confidence. Here's the bottom line. Mortgage rates above 6.8% are cooling demand. Inventory's up, but sales are down. Prices are steady or growing in some regions, falling in others. Climate risks and insurance challenges are only getting bigger. Political decisions, from tariffs to trade wars, are adding new hurdles. Looking ahead, if inflation cools, we could see rates drop a bit, offering some relief. But for now, affordability remains a major challenge for first-time buyers and many families across the country. Thanks for watching. Stay informed, stay resilient, and let me know how these changes are affecting you. Drop a comment below. Don't forget to like and subscribe for more updates on the housing market and how politics shapes your wallet. Until next time.